Great. Dale in Nebraska, you're on the air with Dr. Ravi Batra. Hey, Dale.
Hi, Tom. Great program.
Thank you.
Excuse me. First off, I'm currently reading Dr. Batra's The New Golden Age. Find it very, very informative. I've got several questions. The first is, Dr. Batra, doesn't credit accelerate the rate of inflation? Number two, what is your opinion on the repeal of the Glass-Steagall Act with regards to CDOs? Mm-hmm. And the third is, are we still waiting for a bubble in the commercial real estate? And the fourth is AMBAC. If you could talk about AMBAC.
Okay, AMBAC. Dale, thank you very much. The Glass-Steagall Act, the repealing of that was really a big problem, wasn't it?
Yeah, that was horrible. That is all because of Wall Street.
Yeah.
And the real estate commercial bubble, yes, it has still to burst. And what was the other question? Two other questions.
Doesn't credit actually drive inflation?
Credit should see. I talked about 4 or 5 indicators of inflation, and CPI, Consumer Price Index, is one of them. That inflation has gone up, but not so much because of all that import from China.
Right.
Now, there we could suffer in the near future if the dollar collapses, but so far it has been under control, the CPI inflation, because of that. But I think that part of the inflation maybe is yet to come.
Yeah, and the Chinese are starting to demand higher wages, and they're looking at being pinched, and they're talking about decoupling the yuan from the dollar, which could be a real significant inflator for the United States.
All that inflationary effect could come up next year after the election, as you said, because we are pumping the economy so much. On the other side, commodity prices are all rising, and dollar is going to fall more, so we could have more commodity inflation in the future.
Right. Chris in Mountain View, California, you're on the air with Dr. Ravi Batra.
Yes, thank you, Tom, and Dr. Ravi Batra. Can you explain the relationship between the Fed dropping the interest rates and consumer loans? Because I don't see a corresponding drop in consumer loans or mortgage rates as the Fed drops the interest rates.
Well, that's the problem with the Fed dropping the interest rates. The Fed does not tell the banks, hey, if you want our money, then bring your interest rates down also. See, this is all...
Well, they don't have the power to insist that, do they?
The whole system is geared, to make the money for businesses.
Right.
And yeah, credit card loans, interest rates don't come down. In fact, they have made those, they have passed those new debt laws, new credit card laws, which are onerous, which are burdensome.
Right. We need to go back to the days of usury laws that say, okay, banks, credit card companies, you can be profitable, but you can be nice and boring profitable while the rest of us are protected.
Right, exactly.
Yeah, okay. Let's see here. Dave in Indiana. Hey, Dave, you're on the air with Dr. Ravi Batra.
Yeah, I was wondering, what do you think about the idea of over, say, the next few months or a year, raising stock market margin requirements to 70 to 90% or more and raising margin interest rates to 40% or more, the same interest rates credit cards companies charge? Over time, this would stabilize the stock market and commodities markets and reduce speculation and the high amount of leveraging.
Isn't that sort of an extreme form of trying to accomplish what Glass-Steagall accomplished with oversight, but the oversight's been pulled out?
This is extreme. No, you can't raise interest rates too much. You should not. But, yeah, the margin requirements should go up. But they really are. It's not the stock speculation that's the problem nowadays. There's so much speculation in the derivatives, where there are hardly any margin requirements. Right. And then there's so much speculation in the commodities market where there's hardly any margin requirements. Yeah, if the margin requirements, if it were up to me, I would outlaw the oil hedge funds, and then you'll see that itself will bring oil prices down sharply, and I will also break up the oil companies. Once we broke up oil companies in 1911, Standard Oil was broken up. Overnight, oil prices fell.
Yeah. It's just like when AT&T got broken up, phone costs fell. I mean, it's you look at monopoly, you're looking at high prices. It's just impossible to get around. Paul in Delaware, you're on the air with Dr. Ravi Batra.
Thanks for taking my call. I'm reading New Golden Age as well and had some questions. You mentioned owning foreign currency such as euros. You recommend owning them in currency form, hard currency, or in an offshore account or some other way?
I would recommend buying some euro ETFs. One of them is called
These are called ETFs, are exchange-traded funds, and these are...
Right. The Euro ETF is called FXE. You can buy it and then sell call options on it to reduce your risk.
Right.
I think that's the way to do it.
Right, and you can buy gold that way, you can buy silver that way, you can buy pretty much anything with an exchange-traded fund.
Pretty much anything, but this Euro ETF, these are safer than other ETFs because here these are backed by hard cash.
Right.
They are backed by cash, actual deposit of cash in the banks.
Okay. Aurelio in Santa Fe, New Mexico. We have about a minute before the break. You have a question for Dr. Ravi Batra.
Yeah, I'm a retired teacher, and I have an IRA, and I had around $250,000 in that IRA, and it's lost $50,000, $60,000 within the last few months. I'm not putting any more money into the IRA, so what should I do with that?
Was it invested in the stock market?
Yeah.
It's a mutual fund IRA.
Yeah. And first of all, we should put in the caveat that neither Dr. Batra nor I are certified financial counselors. We can't offer you individual advice.
Yeah, we're not certified. We can only offer you common sense.
Yeah, there you go. So what to do? What to do if your IRA is dropping?
I would say, first of all, I would convert the IRA to a bank IRA because banks' IRAs, I think, are protected by government agencies.
In other words, put it into CDs with your bank, that kind of thing, or into a money market fund?
First, if it's an insurance company, transfer it to a bank. And then, put it into CDs or all the...
Put it into cash instruments. In other words, get out of the stock market.
Right. Stock market is very different.
Okay, 45 minutes past the hour. We're talking to Dr. Ravi Batra. We'll be back with your calls for him right after this. 9.5 minutes before the hour, it's the Thom Hartmann radio program. Speaking from behind the good old stainless steel working class microphone. The Thom Hartmann program powered in part by Teamsters for Change. It's time for change in Washington, D.C. You can find out more at teamster.org. We're talking with Dr. Ravi Batra, the professor of economics at Southern Methodist University, internationally best-selling author. His latest books, The New Golden Age, The Coming Revolution Against Political Corruption and Economic Chaos, and his previous book, Greenspan's Fraud, the most recent, although he's been writing best-selling books for a long, long time. Sir, back to the phones. Here we go. Steve in Lake Oswego, Oregon. You're on the air with Dr. Ravi Batra.
Thank you for taking my call. I wanted to ask Dr. Batra to explain how the tremendous deficits in the war in Iraq have affected the value of the dollar.
It's not helping, definitely, and the deficit is adding to our debt, and the more money we have to borrow from China and Japan, so it keeps more money. It just makes the dollar worse than before. So, but still, we should not worry about China and Japan unloading their dollars. The bigger danger is that private groups could unload their dollars in the past, dollars in the market, and that's what they're doing. In fact, that's why the dollar is going down.
So China and Japan are not suicidal, but there may be the way that George Soros made much of his fortune was unloading Thai baht, as I recall, speculating in currencies in the Far East.
Right. So private individuals will, of course, buy and unload currencies. But governments, as far as China and Japan are concerned, they are only going to buy dollars because they want to support their economies.
Right, the economies that are buying their products.